students, welcome to my live teaching learning session of Financial Economics BECE 144. Today is the last session of this financial economics paper, and today we will discuss about block 6 and 7, in which forward and future contracts, option swaps and other derivatives, and corporate finance and corporate policy. All these topics will be covered in these blocks 6 and 7, unit 13, 14, 15 and 16. All these units will be covered in these topics and in this block 6 and 7. You know that financial economics is very important at present. We have to know about what financial economics tells us. Finance also play a very important role to run any business enterprises smoothly. Without finance, investors can't invest their money in business enterprises, and if financial institutions are not available, then household people can save their money and get higher or maximum rate of interest or reward. So financial economics and financial markets, financial instruments, all these things are included in financial economics. It tells us that how savers can get maximum reward after lending their money to the financial institution, and how investor can get maximum money and they can borrow money from any financial institution at the lower rate of interest, so that both the goals should be maximized. So in this block, first of all, we will discuss about forward and future contracts. What are future and forwards? What is the meaning of this futures and forwards contract? Future and forward contracts, more commonly referred to as futures and forwards. These are the contracts that are used by businesses and investors to hedge. Hedge means to cover up the risk which involve in these market or these contracts. So these are the contracts that are used by the businesses and investors to hedge against risk or speculate. Futures and forwards are examples of derivative assets that derive their values from underlying assets. Both contracts rely on locking in a specific price for a certain asset, but there are differences between them. You know that there are two types of financial market. One is exchange derivative market, and second is over the counter trade market. And there are another two types of market. One is capital market and other is money market. And we can also classify these financial market into two parts: primary market and secondary market. Secondary markets are generally known as derivative market. So futures and forwards are the contract used by the investors or businesses or business enterprises to hedge against risk or speculate. What is the definition of forward contracts? Forward contract is an obligation to buy or sell a certain asset at a specified price, that is forward price, at a specified time. It means contract maturity or expiration date should be mentioned. Typically, these types of contract are not traded on exchange. We can't swap, we can't exchange. Sellers and buyers of forward contracts are involved in a forward transaction which will happen in future, not at present, and are both obligated to fulfill their end of the contract at maturity. It means these contracts are fixed on forward price at a specified time period is also mentioned in forward contracts. It means maturity date or expiration date is mentioned when we are dealing with forward contracts, and these are the contracts or an obligation to buy or sell a certain asset. Typically not traded on exchanges, but sellers and buyers are involved in a forward transactions and both are obligated to fulfill their end of the contract at maturity or expiration date. This is the meaning of forward contract. Now next definition is future contracts. What is the meaning of future contracts? Future. You know that there are three types of time period: past, present, and future. Future contracts are those contracts which are deals with the time period of future, not at present. It deals with future time period. It deals with the future means the time which is uncertain, which we can't predict about that and not sure about that. So these are the contracts which is generally same as forward contracts, but except for two main differences. There are two main differences between future contracts and forward contracts. Futures contracts are settled daily, not just at maturity. But as we have defined, forward contracts are those contracts which are fulfill all the obligation at the end of the maturity or expiration date. So futures contracts are settled daily, not just at maturity, meaning that future contract can be bought or sold at any time. There is no specific time period in forward contracts. Like in forward contracts, there are a time period, specific time period like expiration date or maturity. You can sell or buy, not traded, typically not sell or buy daily. But future contracts are those contracts which can be settled daily. It means it can be bought or sold at any time, not just at maturity. And the second difference is futures contracts are typically traded on a standardized exchange. But as we have discussed earlier, that forward contracts typically not traded, but future contracts can typically traded on a standardized exchange. These are the two basic difference between future and forward contracts. Generally, we can say that futures are the same as forward because in forward we are forwarding anything for future, and future means those contract which deals with in future, not at present. But here, both concepts are not similar, both contracts are not similar. Future contracts can be settled daily and can be sold or buy at any time, and typically they can be traded on a standardized exchange. But forward contracts cannot be typically traded and they will be settled at a specific time or in future or a specified or maturity date or an expiration date. Next is the difference between forward and future contracts. Forward versus future contract. What is the difference between these two contracts? First is nature. The basis of difference is nature. The nature of forward contracts are customized, but future contract nature is standardized contract. Trading forward contracts generally traded at OTC platform. OTC is over the counter exchange. But future contracts can be traded daily or through exchange only. Few forward contracts are less liquid or less mobile. Liquid means which cannot easily converted or easily changeable. But future contracts are more liquid or highly liquid. It means high liquidity present in future contracts but less liquidity present in forward contracts. Next is counterparty risk. अगर देखा जाए, in this counterparty risk mainly involved in forward contracts, but in future contracts counterparty risk is negligible, and the settlement is, in case of forward contracts, it can be settled by delivery, and future contracts can be settled or offset or through delivery. Next is margin. The basis of difference is margin. In forward contract, there are no margin system involved in it, but in case of future contracts, compulsorily need to be paid and perform. It means margin is compulsorily need to be paid and perform. Next is mark to market. Forward contracts are not marked to market because they are not typically traded, but future contracts marked to market on daily basis and typically they can be traded. So these are the basic difference between forward and future contracts. Next is, what is the meaning of swap? Swap is a system in which we can exchange the cash flow or liabilities from two different financial instruments. A derivative contract. First of all, swap is a derivative contract through which two parties exchange the cash flows or liabilities from two different financial instruments. That is called swap. Or swap is an obligation in which generally we can swap the asset or financial instrument. Next is swap derivative. What is the meaning of this swap derivatives? Today, there are a number of non-standard or non-generic swaps used by financial and non-financial corporations to manage their varied cash flow and asset and liability positions. There are so many standard and non-standard or non-generic swaps which is used by the financial and non-financial corporations at present to manage their varied cash flows and asset and liability position. Two of the most widely used non-generic swaps are the forward swap and options on swaps, or it is also known as swaptions. So there are two types of swap which are generally used in case of non-generic or non-standard swaps. In these two types, we include forward swap and option on swaps. Now, what is the meaning of forward swap? Forward swap is an agreement to enter into a swap that starts at a future date at an interest rate agreed upon today. It means we can swap, we can exchange our financial asset or any cash flow or asset and liability position. We can swap. It's an agreement to enter into a swap or exchange that start at a future date, because word is forward, which is not deals with at present, but the rate of interest at which parties will be agreed and be fixed at present, but swap will be done in future. So forward swap is an agreement to enter into a swap that starts at a future date at an interest rate agreed upon today. And next is option on swaps, which is known as swaptions. In turn, is a right but not an obligation to take a position on a swap at a specific swap rate. Option on swap or swaption is not an obligation. It is a right of the investor to take a position on a swap at a specific swap rate. These two are known as types of swap, or non-standard or non-generic swaps: forward swap and swaption, or options on swaps. Next is, now there are types of swaps are different forms. We can show it with the help of this table. Here, interest rate swaps, equity swap, zero coupon swap, currency swap, commodity swap, credit default swap, and total return swap also exist here. So these are the 7 types of swaps, in which first type is interest rate swap. The parties decided to switch one type of interest rate payment with another type of interest rate payment. Of interest rate swaps are plain vanilla swap, basis swap, amortizing swap, step up swap, and differential swap. And equity swap is the underlying security in this swap is a stock or stocks or a stock index. Equity means shares or stocks. They may be preference or they may be general preference share, equity share. There are 2 types of shares. So equity swap, in this the underlying equity or securities and these are called stocks or stock index, is generally deals with an equity swap. Next is zero coupon swap. Zero coupon swap is such a swap works similar to interest rate swap but gives more freedom to one of the parties. Zero coupon swap is generally same as interest rate swap but it gives more freedom to the parties, one of the parties. Next is currency swap. Currency swap tells us that we can swap or we can switch over the currencies. The parties agree to swap principal and interest money in different currencies like in dollar or in euro or in pound or in yen currency, etc. So parties agree to swap their principal and interest money amount in distinct currencies, that is known as currency swap. Next is commodity swap. Commodity swap, it enables parties to swap floating cash flow on the basis of spot rate. Spot rate is that rate in which trade can be done on the spot or at present rate. So it enables parties to swap floating cash flow on the basis spot rate of a commodity with fixed cash flow on commodities predetermined price or prefixed price. Next is credit default swap. These swaps work like an insurance policy. Insurance policy gives us assurance. Insurance policy makes us surety. It gives us surety that this much amount we will take in future. We will take back in future. So credit default swap. These swaps work like an insurance policy and offer protection against the default of a debt instrument. And the last type of swap is total return swap. Total return swap, such a swap enables parties to enjoy benefits of security without actually owning it. If you actually don't own this type of asset, but you can swap and you can enjoy the benefits of these securities, either it may be actually owned by you or not. So this is called total return swap, which enables party to enjoy benefits of security without actually owning it. So these are the types of swaps: interest rate swaps, equity swap, zero coupon swap, currency swap, commodity swap, credit default swap, and total return swap. Next is types of swap, in which first type is interest rate swap. Interest rate swap, it's a series of interest payment between the two parties. The two parties agree to exchange a series of interest payment in the same currency at the various settlement dates. Settlement dates may be more than one. More widely used than currency, this type of swap widely used by the investors rather than currency swap and equity swap, because nearly all businesses face some form of interest rate risk. A plain vanilla swap or vanilla swap is a swap in which one party pays a fixed rate and the other pays a floating rate. You know that there are two types of exchange rate. One is fixed, other is flexible. or floating. Fixed exchange rate generally fixed by the government, which remains always fixed. There is no possibility of change in that rate. But floating exchange rate is that rate which can be vary, which can be changed according to its name. It's a floating or flexible, which can be easily changeable. And it is fixed by the help of demand and supply curve intersection. So in case of plain vanilla swap, it's a swap in which one party pays, or party pays a fixed rate, party will pay fixed rate, and the other will pay a floating rate. If both the rates simultaneously work in a single swap system, that is called plain vanilla swap, which is also the part of interest rate swap. Next is interest rate swaps. There are so many types of interest rate swaps, like interest rate swaps. Four types of swaps generally we use. One is interest rate swaps, other is currency swaps, third is cross currency swaps, and fourth is credit default swaps. First is interest rate swaps. Interest rate swaps means exchanges on fixed rate system, payment for floating rate payment. Exchange will be done on fixed rate, exchange of fixed rate payment for floating rate payment. That is interest rate swap, and it is known as plain vanilla swap. Next is currency swap. Currency swap in this exchange of liabilities in different currencies like yen, dollar, euro, pound, etc. Here exchanges can be made possible with the help of different currencies. Next is cross currency swaps. Cross currency swap is the combination of interest rate and currency swap. If both interest rate swap and currency swap both are combined with each other, then the combination of interest rate and currency swap is known as cross currency swap. Next is credit default swaps, exchange of premium payment for default protection. This type of swap gives us protection against defaulter payments. So exchange of premium payment for default protection, that is called credit default swap. These are the types interest rate swaps. There are four types of swaps. One is interest rate swaps, currency swap, cross currency swap, and credit default swap. Next is now patterns of corporate financing. What is the meaning of this pattern of corporate financing? What type of pattern used by corporate sector to finance their corporation? Do firms rely too much on internal funds, or generally firms rely on external funds? On an average, internal funds, there are two types of funds from which a corporate sector can finance itself. One is internal funds, other is external funds. On average, internal funds in which retained earning is that part of profit which is not divided or distributed among the shareholders, or which can't be used for paying corporate tax. It is retained earning. Retained earning is the part of profit, because profit can be divided into three parts. One is dividend, next is corporate tax, And next is retained earning. Retained earning is that earning which any corporate sector or any business enterprises keep the part of that profit for future growth and development of the business enterprises. That is called retained earnings. Plus depreciation, because firm always make depreciation account and depreciation fund in which firm keep some money for the settlement of or for the maintenance of any capital asset. So depreciation and retained earning is known as internal fund, which cover most of the cash needed for investment. But are managers too reliant on it? Managers may avoid positive net present value projects which require external finance, avoid the discipline of capital market. Net present value is the value of capital asset which we have studied earlier in earlier blocks and other units. So managers may avoid positive net present value projects which require external finance, avoid the discipline of capital market. Now perhaps avoiding external financing has two advantages, has other two advantages, like it is costly to issue new securities, and next is new equity issues can signal bad news to investors. It can signal lower future profits or higher risk, because there is a trade off between risk and profit. If there is a too much risk, then it maybe lowers the future profit, and higher risk, it can be signal of lower future profits. So perhaps avoiding these external financing, if we avoid these things, then it will be advantageous for the business enterprises. First is it is costly to issue new securities, and next is new equity issues can signal bad news to investors. It can signal that lower future profits or higher risk. Thus, it may be good idea to examine carefully while doing investment in any project or require new equity finance. So it may be good idea to examine carefully projects requiring new equity finance. Next is corporate financing patterns in emerging markets. Companies in emerging market rely on debt much more than equity to finance their investment. We know that each and every firm can't fulfill their financial need internally. These corporate sectors or business enterprises have to rely on external securities or external sources of funds like debt and equity. But companies in emerging market generally wants to rely on debt much more than equity to finance their investment. Moreover, they rely on short-term debt even when they are engaged in long-term investment. Debt may be long-term, debt may be for short time period, and debt may be for medium time period. Short time period is known as 1 year, or 12 months to 15 months time period is known as short term. 12 months to 15 months to 5 years time period is known as mid time period, and above 5 years total 20 years is the time period of long term period. Generally, companies rely on short term debt, which is related to 1 year or 15 months time period. Even when they engage, if they engage in long term investment but they want to rely on short term debt. Banks, not capital market, are the primary source of funds for firms in developing countries. Banks are the main primary source of funds for firms in most of the developing countries. Next is now the sources of finance. What are the main sources of finance? We will introduce here the sources of finance. Sources of finance are the most important or explored area, especially for the entrepreneurs about to start a new business. It is perhaps the toughest part of all the efforts. These are various sources of finance. There are various sources of finance classified based on time period, like short time period, medium time period, and long time period. It is also based on ownership and control and source of generation of finance. So, what are the various source of finance? Because for finance is the basic need of each and every business enterprises. Without finance, no one industry, no one business enterprises can fulfill their all economic activities or business activities smoothly. So, what are the various sources from where they can get money or finance for running their business activities smoothly? In this topic, we will discuss about the sources of finance, which are the most explored area for the entrepreneur about to start a business. But this is also a toughest part of all the efforts also. There are various sources of finance which can be classified into basis of time period, ownership and control, and sources of generation of finance. Next is what are the sources of corporate financing? There are generally two sources of corporate financing. One is internal source of finance, other is external source of finance. Firm can corporate sector or firm or business enterprises can take internally. They can arrange funds for investment internally and they can arrange funds for business activities externally. Firms may raise their funds from internal sources by plowing back profits rather than distribute them to shareholders. Like retained earning plus depreciation is the main source of internal sources of fund from which investor can rely and depend for investment in their business enterprises. And firms also use external financing or source of external finance. They may choose between debt or external equity sources. Generally, people choose debt, but debt create burden of paying the rate of interest and after the time period from which debt is taken, you will have to pay whole principal amount of that debt. And what is equity? Equity is a share market or shares through which a company can raise its fund. Company can issue shares like preference share, equity share, and sell it to common people. Common people can buy these shares at specific price which is mentioned on that share and they can become shareholders. And company should give dividend to those shareholders who have bought their company's share. And what they want to take in return? Shareholders always want to take in return dividend. So these are the sources of external finance, equity or debt. Corporate sector can make a choice in between of debt and external equity sources. Now these are the sources of finance chart. Here borrowed capital, owned capital. Sometimes company can use its own capital in business enterprises. Sometimes company can or corporate sector can borrow capital from commercial banks, from financial institutions, and preference shares and owned capital, external or internal, and debentures, private equity, term loans, and control working capital. There are different types of sources of finance. One is borrowed capital, second is owned capital, third is external source of finance, and fourth is internal source of finance. Internal source of finance, we know that here retained profits, reduction of working capital, and sale of assets, depreciation, these are the main sources of internal finance. It can fulfill the requirement of the business enterprises investment requirement. It can be fulfilled by internally. External source of finance in this equity shares, preference shares, convertible debentures, venture capital or risky capital, venture fundings, all these are included in external source of finance. Owned capital means a company has its own capital which company can use in business through equity shares, internal accruals, preference shares, and convertible debentures. All these private equity, or it's known as owned capital, it's also the source of finance. And borrowed capital, capital can be borrowed by financial institution, financial markets, banking institutions, or commercial banks. So these are known as debentures or debt. So these are the various sources of finance of a corporate sector. Next is, what factors affect the choice of the sources of funds? You know that there are so many sources of finance or funds. How a firm choose in between of these above sources of finance, which source is much better for its business enterprises? How firm can take decision? What factors affects the choice of the sources of funds? We will discuss about these points, which is the all factors affecting the choice of the source of funds. First is cost. First of all, while deciding which source of fund we have to choose, first of all, we will see about the cost of that fund. If cost of that fund is higher, we will choose less that fund, and the cost of production, cost of that fund is lower, then we can take that source of finance. Next is financial strength and stability of operations. Financial strength and stability of operation should also keep in mind while choosing the sources of funds. If financial strength and operations are more stable, we should use that type of source of fund, which will strengthen your corporate sector financial uh, financial unit and provide more finance and stability in operations. Next is form of organization. What type of organization you are dealing with? Like it's a sole proprietorship, partnership firm, or it may be uh, in individual sole proprietorship. In that sole proprietorship we can use our own capital, and if we have partnership then we can use money, borrowed money from or partners can invest their money internally. Internal sources of fund can use in partnership firm. But if any corporate sector or big industry is the form of organization, then we can take externally, and we can use external source of finance. Next is purpose. What is the purpose of the business enterprises? Purpose of the business enterprises also also responsible for making choice in between of sources of funds and time period. What time period you want to take fund? Like if you want to take a fund from borrowings, then time period is higher. For long time period, that will be highly costly. And risk profile is also the main factors affecting the choice of source of fund. If there is too much risk in that source of fund, investors will not take that source, will not choose that source of fund, and risk is less, then firm or business enterprises can choose that source of fund. Control and effects on credit worthiness and flexibility and ease and tax benefit also, all these factors affects the choice of the sources of funds. There are some other factors like factors influencing the choice of a source of fund or purpose of use of fund, for what purpose you are using that fund, cost consideration and opportunity cost you keep in mind, how much gain you are taking. Then if you want to gain something you have to lose something also, that tells us by opportunity cost. So opportunity cost or cost consideration also keep in mind while choosing the sources of finance. Status and size of business firm also decide what type of source of finance it needed, what amount or how much amount a company or business enterprise is required. It also the most important factor affecting of choice of a sources of finance. And flexibility, if you think that some source of finance are more flexible according to, they can increase or decrease or raise the funds according to the requirement of the business enterprises, then business person will follow that type of source of finance. State of the external environment, consideration of externalities, and gearing the relationship between share capital and loan capital, high geared risky. So we should make the relationship also in between of share capital and borrowed capital. How much we have to take money from share capital and how much money we have to take from borrowings. What is the proportion of debt and equity? This also affects the source of choice of a source of finance. Next is ESG. What is the criteria of ESG? Is environment, S is social, G is governance. So environmental, social, and governance, these all things tells us a set of standard for a company's behavior used by socially conscious investors to screen potential investment. So while investing money in business enterprises, we should keep in mind that money should be used for protecting environment and providing social benefits to the whole society people, and governance also should be uh, good. So, environmental, social, and governance criteria is a set of standards for a company's behavior used by socially conscious investors to screen potential investment. Next is history of corporate finance. Corporate finance, how is this concept originated, and what is the history or past of this concept, corporate finance? History of corporate finance provide comprehensive information of corporate finance India. It also focuses on types of services offered by corporate financing community in India. You know that in India there is a two time period, or two time period is divided into two parts: pre-reform period and post-reform period. Before 1990 time period is known as pre-reform period, and after 1991 time period to till now or onwards is known as post-reform period. The economic renaissance in the 1990s brought by liberation of Indian economy had a stupendous effect on the financial health of India. The Indian financial market, which was previously insulated from foreign investors, were thrown open for foreign investment. And with modern economic policies like new economic policy at par with Western countries, in operation large quantum of FDI limit was before 1991 only 49%. But after adopting this new economic policy of 1991, in which liberalization, privatization, and globalization mainly taken. At that time, FDI limit raises from 49% to 51%. For some specific industry, FDI limit is 74%, and for some other industries, at present, 100% FDI is permitted with automatic route without taking any permission from the government. So FDI is the main source of finance of the corporate sector. The rise in business activities and its subsequent rise in financial activities led to the need of proper and accurate financing for corporate in India. So corporate finance provide businessmen, investors, and entrepreneurs with finance and advice for proper and risk free investment with an eye for maximum return. This is the history of corporate finance. Next is green bond. What is the meaning of this green bond? A green bond is a kind of fixed income instrument which is usually used to finance environmental projects like controlling pollution or pollution precluding. Green use of proceeds revenue bonds, green use of proceeds bond, green securitized bond, and green project bond. So there are these different types of bond. Green bond generally deals with environmental projects, and it provides finance for environmental security or protection. Next is benefit of these green bonds. Green bonds supports long-term finance for low carbon and carbon resilient projects. For investors, green bonds carry on environment benefit without sacrificing financial return. And for issuer who issue these green bonds, new investors are attracted. These are the benefits of green bonds. Next is green bond milestones in 2007. First of all, this concept came at in which year? 2007, first ever green bond issued by European Investment Bank, USD 807.2 million. After that, in 2014, first certified climate bond, Electric Solar in UK. After that, in 2015, this green bond market hits the $100 billion mark in cumulative issuance. In 2016, first green sovereign issuance Poland. Then in 2017, France comes to market later, going on to becoming the largest sovereign to date. With Fiji sovereign issues to market, Nigeria becomes the first certified sovereign issuer, and green bonds market hits $250 billion in cumulative issuance. And in 2018, Indonesia, Belgium, Lithuania, Ireland green bond market hits $517 billion in cumulative issuance. In 2019, Netherlands, Chile global market hits the $783 billion in cumulative issuance in green bond. And 2020 green bond market hits 1 trillion in December 2020. So this green bond milestone can be shown in this way. Now, what is the meaning of securitization? Securitization refers to the process of converting debt, usually liquid assets, which can be converted, usually illiquid assets, into securities, which are then bought and sold in financial market. Banks, financial institutions will collect money in a pool, division a pool into small parts, and selling them as securities. Then these securities are called mortgage or backed securities. Buyers of these securities get interest, mortgage payments, and usefulness of these type of securitization is it boosts up the liquidity power of the businesses enterprises, help raising funds, portfolio diversification, and quality returns. But limitations are also present here, risky for lenders and difficult to access the risk factor in securities. That is the meaning of securitization and its benefits and disadvantages of this. Next is Startup India Seed Fund Scheme. You know that at present, Government of India is providing financial facilities for Startup India, and in this project, Startup India Seed Fund Scheme initiated by the government in January 2016. The Government of India launched Startup India Seed Fund Scheme 2021 to foster the growth of startups in India, and mainly preferences would be given to startup creative innovative solution in which sector: water management, waste management, financial inclusion, education, agriculture, food processing, biotechnology, healthcare, energy, mobility, defense, space, railways, oil and gas, textiles. Next is corporate policy. What is the meaning of corporate policy? Corporate policy is that policy which is generally made for corporate sectors, and corporate policy is basically a document containing broad guidelines which is created after analyzing all internal and external factors that influence the organizational objectives, operations, and plans. Top management has the responsibility of formulating corporate policy from various perspectives. We can say that corporate policy is different from corporate strategy. Corporate policy helps in implementing corporate strategy and future planning of the organization. The general statement of principles are: policies are general statement of principles followed by corporate for the attainment of organizational goals. These principles provide a guide to action for the executive at different levels, like long-term perspective. These corporate policies have a long life and formulated with a long-term perspective. Achievements of objective: corporate policy aimed to fulfill the targets of the organization, and it works for the achievement of these goals. Qualitative, conditional, and general statement. Corporate policy statement are qualitative in nature. They are conditional and defined in general manner. These statements use words as to maintain, to follow, to provide, etc. They can be specific at times, but most of the times a corporate policy tends to be general. Now, corporate policy is based on mutual application, unified structure, positive declaration. Corporate policies are meant for mutual applications by subordinate, unified structure. It has unified structure, avoid repeated analysis, and positive declaration. is also included in corporate policy. Now, conclusion of this block 6 and 7, unit 13, 14, 16, and 15 and 16 is corporate policy is an organization which is formulated for corporate sector, mind a number of internal factors that influence corporate, and these policies are basically for industry, social environment to protect legal environment and politically environment, economic environment, etc. So this financial economics last unit and all blocks are covered in these live sessions. Thank you.